With the lock-in period for Yes Bank shares expiring this Monday, the stock plunged over 13% intraday before closing 5% lower. The shares closed 0.5% lower on Tuesday. 3 years ago, State Bank of India or SBI, HDFC ICICI Bank, Axis Bank, Kotak Mahindra Bank, Federal Bank, Bandhan Bank and IDFC First Bank had cumulatively invested Rs 10,000 crore to bail out the ailing lender. Going ahead, analysts do not expect brutal hammering of the shares as the bank has been able to improve its financial performance significantly.
Yes Bank was rescued by about 8 institutions led by SBI, which gave them nearly 80% stake at that point of time. But now that's substantially lower due to the mega FPO in 2020. Some like Federal Kotak as well as IDFC First sold part of the free to sell portion immediately after the allotment, taking advantage of the crazy rise post the rescue. And I'll not be surprised that they would have possibly recovered the full investment by then, since they had subscribed at rupees 10, whereas the stock moved to levels of 60 plus in those few days when they were selling before settling much lower. I'm sure that SBI will not sell, being the lead, and I don't expect any of the other rescuers to resort to dumping the stock now, as the bank has turned around decently well, clearly on the growth path. So, having waited for about 3 years, quite sure that they may wait for another two for much better returns.
From a net loss of Rs 16,400 crore incurred in FY20, Yes Bank turned profitable in FY22 with a net profit of over Rs 1,000 crore. So far in the current financial year, the bank has incurred net profit of over Rs 500 crore. Its loan book, meanwhile, has expanded from Rs 1.71 trillion to Rs 1.94 trillion between FY20 and Q3 FY23. Gross non-performing asset ratio or GNPA2 declined from nearly 17% in FY20 to just 2% as of December 2022. Given this, ICICI Direct Research believes the bank is poised to pedal higher advanced growth driven by granular retail assets as it concluded Rs 8,900 crore of capital raise from Carlyle and Advent. Focus on growth along with margin improvement may enable the bank to improve its return on asset to around 1% in FY25. That said, the near-term risks are security receipt of Rs 3,800 crore and aging on the same. This, analysts said, could keep earnings volatile on a quarterly basis. Moreover, write-down of 81 bonds too is a near-term overhang. On the bourses, shares of the lender have crashed 31% in just 3 months. Independent market analyst Ambarish Baliga says this reflects pricing in of these headwinds. Retail investors could thus hold the stock while new investors may buy on the dip. Brokerage firm Swastika Investmart too believes the shares may hit Rs 25 levels in the medium term if SBI and other marquee lenders maintain their holdings. Bulk deal data shows that none of the lenders have so far sold their stake after the expiry of the lock-in period. In a nutshell, the stock could stabilize from here on if it ensures consistent asset quality improvement and loan growth. As regards today, markets will react to news flow around Silicon Valley Bank and US inflation data released overnight.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.